Good morning. I'm Jeff Pomerance of SulmeyerKupetz. Thank you for joining me this morning. Our program is entitled Making Sense of Lending Options in Today's Market, a primer for financial officers and advisors. I prepared a PowerPoint presentation to accompany this program. I hope it will be helpful. With the hyper competition and the business climate that we are facing and we're seeing today, with razor-thin margins, it is no secret that every dollar counts. I hope that we can help you advise your clients and your company as to how to save money while growing your business and operating your business. This program arose out of my experience and my experiences as a corporate transactional attorney. The PowerPoint presentation provides a brief description of my background. I will not bore you with it at this time. Rather, I've received a number of calls over the years from clients, and I've shared a few with you here. I just got a written notice that the company is in default. I do not understand what happened. Well, in this case, the problem is the client or the borrower does not understand what the loan document requires. Or consider another one. Our CFO tells me that despite the fact that sales are up, we were hit with a lot of upfront charges. Our business is fine, yet I'm told that we are in trouble under the loan. What do you suggest? The problem in that case appears to be that the borrower is in financial covenant default. Or, I had a really successful month. Sales were great. Yet I'm thin on my loan and strapped for cash. The lender is not willing to extend credit for us to buy more inventory. What happened? In this case, it seems that the borrower does not understand what a revolving loan entails. In another instance, we have plenty of cash but have a problem with a large account receivable. Just heard that our loan does not let us borrow even though we're doing okay otherwise. What's going on? The problem there may very well be that the borrower does not understand factoring. Clearly, excuse me just a moment. Clearly there are problems. And as noted, they vary based on the facts and circumstances. The bottom line is there is a problem and it needs to be addressed. With this in mind, today's program will attempt to explore the following. Skip around here a second. The program will attempt to explore the limited focus being best practices in securing debt financing, and credit advances, with the goal, the ultimate goal, of effectively managing the debt financing and credit advance process to maximize leverage, minimize costs, and help drive cash flows. As we will discuss, this involves a number of areas to explore. Knowing your company, its needs and capabilities, knowing secure debt financing options, and being able to evaluate those options which best fit your company's needs. Coordinating a team approach to procure and negotiate these loan opportunities. Developing and implementing a game plan. Know what your loan provides and what are the pitfalls and concerns. And ultimately monitoring performance, establishing accountability. That's the goal. Sounds easy, but it's really not. Let's begin by exploring what this entails, recognition, of certain basics. Before we can really begin to discuss best practices for securing debt financing, we need to recognize some basics. Number one, you can't change the past. Too often, when something is brought to my attention, the document is either submitted for finalizing, the document's already been negotiated, or in those instances where we've been helpful with kind of procuring these opportunities, they've already made agreements as to what the borrower is willing to do. So you certainly cannot undo what is already done. Second aspect is these are form documents. And in both for purposes of this program and in a true fashion, these terms one has to think of as non-negotiable. My first experience negotiating a loan document was in 1987, 1,000 years ago, and the partner involved gave me the loan documents and told me that the meeting was the next day and I was to prepare to negotiate the terms with the bank and its counsel. And I remember going through, these are very thick documents, and I had pages and pages of points and suggested changes, and section 19 was inconsistent with section 43. And I walked in that morning and we sat down and I started to go through line by line, and I was met with laughter. And the response from the opposing attorney was simply, Jeff, your client can either sign the document as is and get the loan, or not sign the document, in which case it was nice to meet you. And it taught me the reality that these are form documents, and that at least for purposes of our discussion today, you really have to assume that many of these provisions are non-negotiable. Another important basic to bear in mind is the difference between knowledge of your business and knowledge of your credit risks. You know your business. You live with it, you operate it, you understand the nuances to it. Knowledge of your credit risk is something that candidly a lender, and a sophisticated lender, knows better than you do. And they're not the same. And when we talk about loan documents, we're not talking about your business, we're talking about your credit risks. So you have to recognize that this is something that a sophisticated lender really knows perhaps even more than you do, even though it involves your business. The next thing to bear in mind is securing debt, credit financing, takes time and costs money. This is all too often, I advise clients, this is really a process and not an event. You'd like it to be an event, but it takes time. And as we'll explore, that sometimes that time is you can use to create value and opportunity for yourself. Lastly, I think it needs to be stated that failure to prepare really is preparation for failure. I think this is a famous John Wooden axiom. But one of the most important things that I hope to impart in today's program is that you really need to prepare for this process so that you do it right and can help your company reach its potential. Okay, so along those lines, let me tell you what you will not hear today. I think it's important to note that this is not a sales pitch for hard money loans. I'm not advocating any particular financing. What I'm suggesting is, after going through this program, you may realize that many of these hard money loans really aren't for you or your clients, but you need to know about them. You need to know what they entail. And if you are in business and need a loan, you have to give thought, and you have to look at hard money loans as one option. Second thing I want to stress is there are no simple solutions. There is no form. There is no checklist. This really entails understanding what you're doing, what the market provides, and what's best for your company. Along those lines, there's no guarantees of outcome, because even when we negotiate these and we have a plan in place, so often things arise that weren't expected. There are inherent risks in business, and the goal of this program is to suggest that you prepare a plan that takes into account risks. But no plan is perfect, and there are always risks that arise that were unforeseen. The last thing is specific deal structure and recommendations. As I noted earlier, many of the issues involved are very fact sensitive. So one deal structure that can work for borrower A will not work for borrower B. But along these lines, as we get into this, I will be sharing with you examples of contract provisions from documents that I've worked on, reviewed, and been involved with. And it's natural to assume, well, I'll just negotiate this or negotiate that. And while there is sometimes an opportunity, I'm trying not to be inconsistent with what I said before, there is sometimes an opportunity to negotiate some specifics. I think that what we really need to do today is to recognize that one has to accept what these are and recognize that what works for your company may not work for another company. Okay. I want to begin by suggesting, let's make sure we know what we're talking about before we jump into some of the specifics. The following key terms and concepts I think are very important as we proceed. And I want to make clear what those are. The first issue is the difference between collateral and borrowing base. The collateral are the assets pledged or granted by a borrower to secure a loan. In a hard money loan concept, that's what the lender will look to. The borrowing base, however, represents specific items of collateral generally used to calculate the amount of loans advanced under a loan agreement. So as we'll see later, the collateral may be inventory, but the borrowing base is a concept called eligible inventory, and we'll see that they're not the same. The next key concept is single advance versus multiple advance loans. A single advance loan, as the name suggests, is a loan in which the borrower obtains the funds in one lump sum payment, generally at the inception of the loan. Whereas a multiple advance loan is a loan in which the borrower may obtain additional funds from time to time up to some maximum principal amount permitted under the loan agreement. As we'll discuss, this concept of single versus multiple advance loans is very significant in finding the loan that works best for your company. The next concept is term loan versus revolving loan. A term loan, as the name suggests, is a loan in which a stated amount is advanced to a borrower for a specified period of term, a period of time, subject to generally early payment on acceleration or mandatory prepayment. This type of loan can be effected through a single advance or multiple advances. So again, a term loan can be in one advance or multiple advances. A revolving loan, in contrast, is a loan in which an amount is advanced to a borrower, generally from time to time, but the amount of which varies according to certain specific criteria, most notably the borrowing base. The next concept to just touch on are the difference between representations and warranties, or as I call them, reps, and covenants. A representation and warranty is a statement that a borrower makes that are generally relied upon by the lender and which require factual determinations to be made at a specific moment in time. So when they're made, they're generally either true or false. Covenants, however, are statements that reflect a borrower's commitment to undertake an action, either an affirmative covenant or refrain from undertaking an action, a negative covenant. Most of the time, people will look at covenants as something to do in the future. That's not always the case. Lastly, I just want to touch on a concept which we'll explore further called factoring. I've seen a lot of factoring deals. I've heard a lot about factoring from people that have come looking for a factoring facility, and I found over the years that there's a great misunderstanding of what factoring really is. Factoring is a specific type of lending facility generally predicated on the sale of eligible accounts receivable, generally approved credit risk accounts, and advances are made net of fees against a borrowing base. So there really is a loan, but the payment of the loan is based on the purchased account collected. Okay, so with that in mind, let's look at what I believe is important to understand is why would someone want to have a hard money loan? Why are they so important in today's business? As I mentioned here, the first thing is that most everyone needs cash or cash infusion to operate. Let's consider some potential sources for raising cash. The first one is cash flow from operations. As this suggests, your company makes money and takes that money and uses the money to satisfy future operational needs. Another alternative is an equity or debt raise. This is generally what we refer to as an offering, either a stock offering or if it's an LLC, units, sometimes it's convertible debt, but it's generally we refer to it as offerings. It is a specific document where the company raises money generally in the market from, more often than not with the companies I work with, private individuals or private companies. And again, there can be debt involved, but generally speaking, at least for this purposes of the program, these debt instruments are more in the form of promissory notes. Then there's what I want to highlight today, which is working capital debt financing and credit advances. This is what we're talking about today, hard money loans. It doesn't have to be. It can be unsecured loans as well as secured loans. But as we'll discuss, the market for secured loans is significantly broader, and as one will see when they go out to the market, it's harder to find unsecured debt, and certainly at prices that are affordable. Now, secured loans for working capital debt financing offer some significant advantages over the other options we've just discussed. First off, there is a vibrant market of providers, which in turn spurs competitive lending. What that means is there's a ton of money available, and you have multiple parties lending that money, which provides for a generally more competitive landscape and a better pricing. Number two is, one of the advantages is reduced legal risks and attenuated costs. When one does an offering, when a company does an offering, whether it be an equity or an equity debt offering, but generally mostly an equity offering, you have to deal with offering memoranda, you have to deal with 10b5 liability. There are a number of risks and factors that go into preparing the necessary documentation to comply with legal requirements. And this comes both at a cost and at a risk. The third thing to bear in mind, and why secured loans for working capital is really the preferred way to go, is the timing and the cost of capital generally favors debt. Number one, there's a fixed dollar amount generally, fixed amount tied to percentage, but it's a fixed amount, and as such, it tends to be less than an equity play where the cost of capital may involve a greater return either through a preferred or a general or a common offering. And again, the timing, because of the market for providers, the market is faster in terms of going out and getting these. I've seen some of these deals on credit card processing, for instance, where it's same-day lending. I wouldn't recommend it, but it's out there. One of the other benefits that's very important is the tax benefits associated with debt. Debt is deductible, whereas payments on account of equity are not. Another important point to consider on why secured lending, credit advances is so important and prevalent is that different loan facilities can be tailored to meet a company's needs and or based on a company's collateral. So there really is options to explore. And lastly, as we'll touch upon a little bit later, credit card transactions, which is a hybrid form of hard money financing, is an absolute, you cannot operate a business in today's climate without having a credit card processing relationship. It's simply, in today's non-cash world, it's simply an absolute requirement. I prepared a schedule. I prepared a schedule showing an overview of hard money financing options. And as you'll see, they're broken down to a number of different categories, generally based on the collateral base. In very brief, there's a secured loan, the blanket as we call it. A lot of times this is from banks, and that's all assets. And you can also have a real estate loan, which is tied to real estate. You can have an inventory loan that's tied to generally eligible inventory. You can have an accounts receivable loan tied to eligible accounts. And lastly, I put other collateral. Intellectual property financing is growing significantly, but there are other assets that I've seen advanced or pledged to secure loans. And as you'll see from this chart, it's very important to note that there's a great deal of variety for each one of these type of loans in terms of the lending, the advances, the interest rate and fees, and the reps and the covenants. Okay. Here's the area I really want to drill down on, go from the general to the specific, and that is the pitfalls and traps. As we're going to discuss in building out a program that works for your company, you need to know your company. You need to know what may or may not fit for it. But with that in mind, how do you make the right choice? So what I want to go through with you now, and I believe it's important to understand, are what are the potential pitfalls and problems that may arise from hard money lending. There are a lot more than these, but I've listed 9 general concerns that I've seen and a couple specific areas of concern related to inventory financing and account financing and factoring. What we're going to do now in many of these is we're going to go through and provide a specific provision, contractual provision, to illustrate the point. Actually, having said that, the first one is more a general concept about pitfalls and pricing. So often when I talk to clients and they talk about pricing a loan, they refer to the stated interest and the default interest rate. There's no question that that factors in the pricing significantly, but that's just the beginning. It's way too simple an approach to simply price a loan based on those rates. For instance, in many loans, there can be an unused line fee. If you have a term loan and you borrow, let's say it's a $10 million term loan and you borrow $4 million, you could be charged for the $6 million you don't borrow. There are facility fees. We have multiple advances. A lot of the time there's fees that go into the process of approving the company for multiple advances. There's also a lot of other charges. There's prepayment fees. Sometimes the lender will require that if you want to prepay the loan prior to the maturity date, you have to pay a fee. There are monitoring fees and costs. There are audits and financial reports. Sometimes there are appraisals. Often, borrowers will ask for legal opinions, which is its own separate pricing because obviously you need to pay for the attorneys to undertake the opinion preparation and delivering of the opinion. And lastly, I think it's important that for real estate in particular, you have title insurance, you may have others. These need to be considered to avoid that terrible moment and one of those calls, I don't understand, I didn't know that this was going to happen. And by understanding these pitfalls, in particular, as an example, the prepayment fee, you can structure your behavior as a borrower so that you don't fall into having to pay for fees that you didn't plan on paying. The next example of a potential pitfall relates to what I call the accounting and reporting function. Now, when you think about it, it seems only natural that any lender will want to know about the accounting and reporting associated with a borrower. I mean, it's in every contract. It's in every loan. So many of the times when I discuss this, what's the problem? Well, as this provision that I've included in the PowerPoint suggests, if you look at this, and I don't suggest you certainly can look at it, but by way of overview, the lender will want to know and drill down on the accounting function and the financials and on the reports. Understandable. But it's vital to know from a borrowing perspective what is needed, when, and by whom. So you look at this example, does your business have the ability to perform the obligations set forth in this provision? And at what cost? Is your business GAAP compliant? Are there audits required? Have you ever had an audit before? Who's going to do the audit? Again, these are all very reasonable. But as an example, if you're going to be required to provide an audited opinion, and you've never done one before, it may not be possible for you to get an audited opinion or an audited opinion within the first year. So you need to know this before you simply accept that. The next thing to explore is what I call the permitteds. What are you in your business permitted to do now that you've received this loan? This is extremely important because these are the types of things where you know your business and you know what you want to do and need to do to grow your business and operate your business. But that's not the lender's concern. The lender's concern, as I mentioned earlier, is credit risk. So there are things that they are going to want you not to do or to do, and you need to understand what those are so that you can affect your behavior accordingly. Okay, so let's look at the first one, and that's permitted indebtedness. Permitted indebtedness is indebtedness that a borrower can incur without being in violation of the loan agreement. Now, it's important to note that indebtedness generally has a very broad definition, and it's literally any obligation or liability. It's not simply a debt. It can be an obligation to provide or perform some service, certainly trade payables, accounts payable. And these types of provisions, as this example will suggest, when you look at this, you need to know that if you need to borrow, if there are multiple borrowers and you need to borrow between companies, or if you're going out and doing capitalized leases, you want to acquire equipment through a capitalized lease. If your company is going to need shortfall funding through shareholder loans, promissory notes, as is typically the case, and certainly even ordinary and course indebtedness, things like trade payables, accounts payable, and payroll, you better make sure that you can do so within the term of this provision. And sometimes, as number 5 suggests, you might be able to do certain unsecured indebtedness, but only up to a certain dollar amount. So it's absolutely crucial that while it's understandable why a lender will want to limit your indebtedness, that you as borrower understand what you're permitted to do. The next example I'd like to share with you is along the same lines, or I call it a cousin to this, is permitted encumbrances. Now, an encumbrance is different than indebtedness because encumbrances is generally a lien, security interest, some sort of claim. So again, it's understandable that a lender will not want you to allow liens on your equipment, assets, and so forth, even if they're senior. So many times they'll incorporate in loan documents a provision as the one I've provided. And if you look through it, it gives certain liens and seems to be, you look through it and you think, okay, great, I understand banks and I understand lessors or sublessors. certainly their lien in particular. But again, looking at it more closely, you will note that what it may not include are liens arising in the ordinary course of business that are imposed by applicable law as opposed to contract. In other words, by you undertaking a certain action, that a lien arises by operation of law. For example, you have situations where there are carriers, warehouseman liens, landlord liens, mechanics liens. These are liens that arise by operation of law. And if you hold inventory in a warehouse, it very well may be subject to a warehouseman lien. Another example is judgment liens, even in nominal amounts. This can arise frequently, and again, it may seem like nothing, but even though the amount isn't significant, nonetheless, it causes a problem with your loan document. And of course, junior subordinated liens, and a concept that is in itself a separate discussion, PMSIs, which is a purchase money security interest. It is a way of financing inventory. So again, it's important to know what is permitted relative to encumbrances. Another example of potential pitfalls relates to permitted distributions. Now this is very, very important. And the potential problem relates to a taxation issue. As a general rule, most loan agreements prohibit a borrower from making any distributions to its equity holders until the lender has been paid in full. This is a standard provision, and generally it reads, borrower covenants and agrees that until all the obligations, whether known, now existing, or hereafter arising, have been paid in full, borrower shall not directly or indirectly declare or make any distributions. Okay, so what's a distribution? Distributions are generally broadly defined, but basically relate to payments on account for equity interests. I've given you an example of a definition here for distribution. Here's the problem. If your company, if your business is not a C corporation, but a subchapter S corporation or LLC that elects to be taxed as a pass-through entity, then as an equity holder, you may have income that's attributed to you, and you haven't been given the cash to pay the tax on that income. And again, there are quarterly and annual distributions that would otherwise be needed for shareholders to pay the taxable liability for their attributed income. And this is, again, quarterly and annual, but it can also relate to catch-up tax adjustments. And I've seen it in a couple of instances where one of the ways that the equity members retired was that the company created a sinking fund to buy back their interest. Because again, many of these opportunities, these companies that are privately held, they can't just go to market and sell their interest. So the company itself created a sinking fund to redeem partners or members when they retired, only to find out that they were not allowed to make a distribution under the loan document. That creates a big problem. Another pitfall we talk about is called the MAC provision. Now, almost every contract has a MAC provision, which is material adverse change. And candidly, it makes a lot of sense. It's very common. And they read as follows, generally. I grabbed one example. A material adverse change is a material adverse effect on the business, assets, liabilities, operations, condition, financial or otherwise, value, operating results, or prospects of the borrowers, taken individually or as a whole. And then I give some other examples as well: material impairment of the ability to pay, perform, material impairment of any right. Now, these provisions are very standard. However, it's important to note that when you think of the following potential occurrences, number one, a general market fluctuation, loss of a significant customer, loss of a material contract, future business and even what materiality means, it's very important to note that these areas can trigger a violation or a breach of a material adverse change, even though your company is doing well and performing properly. One of the areas that I've seen real problem is when you have a provision like the one we've just provided, where it says material adverse effect, and it says taken individually or as a whole. When you have multiple borrowers, like a parent and subsidiaries or affiliated companies, and one of them's not doing well, but the other's doing extremely well. So overall, they're doing fine. But nonetheless, with that in mind, you realize that you could breach this provision even though your company is performing, you as a borrower are performing well and doing what you hoped to do. Another area, a pitfall, a trap to understand or to note is the concept of mandatory prepayment obligations. Now, a mandatory prepayment is a requirement to repay interest and or principal prior to the stated maturity date. Giving you a common example, and you see that you have a number of instances, one of which is the incurrence, the third bullet is the incurrence of any indebtedness other than permitted indebtedness. But these are events that can arise, the result of which is that payment that you planned on making in the future on the maturity date, all of a sudden all or a portion of it is due now. And it's important to note that this is not related to a breach. You're not in breach. You didn't violate the agreement. You're performing. Nonetheless, something happened which triggered a prepayment. Now, what could those things be that you have to be sensitive to? Number one, sale of obsolete equipment. As the bullet point above suggests, the first one, any sale other than sales or exchanges of inventory in the ordinary course of business, transfers, dispositions, this is very broad. So the question is, if you decide to move obsolete equipment, does that trigger a mandatory prepayment? I've seen situations in which when the obsolete equipment was sold, that the money from that sale had to go to pay down the loan, even though the borrower planned to use that money to buy new equipment. The next thing that I've seen is fire and property damage. And this is an area that really needs to be addressed, because if there is damage, most likely the borrower wants to take the insurance proceeds and use that to repair or replace what has been damaged. You need to be careful, and you need to know that sometimes these type of provisions can result in the money being paid going not to repay or to repair, but has to be applied to the lender. And lastly, the idea of additional debt for working capital. If there is a requirement that debt other than permitted indebtedness is required to be used to prepay, what you find is the shareholder who's decided to advance money to his or her company to cover a shortfall, instead of using that money to increase operating working capital, it's used to pay down the loan. One of the next pitfalls that I want to highlight is an area that I see all too often. It's financial covenant compliance issues. This is one of the more challenging, because really this requires a team approach. When a lawyer is negotiating these terms, and generally most lenders will ask for something like this, even though it doesn't go to the collateral or borrowing base, it does go towards the ability of a company, a borrower, to perform. So financial covenants are routinely, there's an attempt to put them in agreements. And so often, without a team approach, these covenants get in there, and then you have to find out later, what do we do because maybe we can't meet them? And again, a covenant is an affirmative this is what we will do, or we won't do worse than this, affirmative or negative covenant, but it is if you will, a promise that this is what the borrower is going to do. So looking at this one in particular, you have this where for a given period, there's a certain minimum EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So it's a financial driven number. Now, consider what happens with market fluctuations, with the loss of a major client, or unexpected expenses in any given period or periods. You could have a business that's otherwise doing well, but could have, in this case, let's say for a 3-month period or 6-month period, could have a really bad, let's say for a 6-month period, they had a really bad first 3 months and they had an exceptional 6 months. And as a result, at the end of the 6-month period, they're fine. Nonetheless, because of the way this particular provision was drafted, that bad 3 months resulted in the company being in default under their law. It's a real problem, and as we'll discuss, needs to be addressed really in an interdisciplinary approach. Another one along these lines is even if a business pledges assets, inventory for a loan, the question is, you pledge those, but you're using those as a business owner to operate your business and build your business. And one of the important things to note here is just there are certain prohibitions. I grabbed 2 examples of inventory, receivables, and management compromises that are made that can significantly affect your ability to operate the business as you would like. These 2 provisions, as examples, illustrate that you may have a very difficult time if you provide customer service, working with specific accounts, customers to address their problems and concerns. Your hands may be tied. Furthermore, you may have problem with consignment and PMSI issues of getting additional inventory, and your ability to move or address slow-moving and obsolete inventory. With this in mind, I want to jump into kind of 2 specifics I mentioned earlier, pitfalls related to inventory financing and the other to account financing, what we call factoring. Now, when we talk about inventory financing, as the examples I've given of borrowing-based definitions, they refer to things like net orderly liquidation value and eligible inventory. And as you see by these definitions, the borrowing base and inventory formulas are dependent upon that. So it's really important to note that the amount available to be advanced and under an inventory financing facility is dependent upon the value of the borrowing base, which in turn is dependent upon the value of a borrower's eligible inventory. And I can't stress that enough. If we look at the next slide, you'll see an example of what a definition of eligible inventory. In this particular instance, if you look at this work in process, packaging, in transit, the bottom line to really take away from all of this is inventory does not equal eligible inventory. And you really need to consider what your real borrowing base is, because how much of your inventory is counted will determine the amount that you're able to draw on that loan. So too, as I mentioned earlier, I hear a lot about accounts receivable financing, which is generally referred to as factoring. I just want to run through very briefly with you, because I think there's a lot of misunderstandings. What is factoring? In very brief, factoring is really a 2-pronged process. As I've discussed here, it's the sale of accounts. A borrower generally sells and assigns to a factor certain accounts that are deemed creditworthy. The factor looks at those, determines, approves them, and in those instances, the assumption of the risk is borne by the factor. The important thing to note here is, separate from that, is one of the reasons why you go to a factor is you need the money now, not when the account is collected. So what the factor does is the factor advances money on approved accounts. And as this illustrates, the borrowing base, which is the basis for how much is advanced, is generally in the factor's sole discretion. And it's the difference between some equation, some percent of approved accounts, less reserves. Now, there is an inventory formula availability, which determines the basis, and there is this reservation as to amounts that they feel, generally factors feel, is reasonably necessary. There are also a lot of fees and other charges. I've provided just a brief example of one, what they'll kind of how that's broken out. But suffice to say, the important thing to recognize is you're going to a factor because you can't wait for you need the money now, you can't wait for your receivables to come in. But with that goes the fact that not all of your receivables will be approved. Only the ones that will be approved are those eligible to borrow against. There are significant charges, and indeed there may be even charges, as this example suggests, of late paying accounts. In other words, you sold it to them, but they can still charge you for the time frame in which they collect the money. There are chargebacks that can result, in this instance, from non-credit risks, and those could be things like valid returns, breach in performance, force majeure events. And lastly, a couple other points to note. There's an inability to modify the account terms. As I mentioned earlier, in terms of managing your customers, you don't have the ability to work with your customers as to open accounts or the performance terms. Two other things to note. Generally, factors have a lien on assets. Sometimes it's only in the accounts. Sometimes it's more. It's very important to know what the scope of their lien is. And this concept of reserves can really limit what you think you would otherwise get. And I want to briefly touch on, so I want to make sure I stay in time, but I want to touch on a unique twist to hard money and secured borrowing, that's credit card sales. I've laid out here an overview of the credit card processing approach. Business today, certainly, it's no secret they can't operate without credit card sales. So what happens is businesses, merchants enter credit card processing accounts with certain companies that typically include the following. And I've listed here 4 kind of typical kind of overview provisions, but a couple things that are important to note. Number one is that these are conditional sales. You've sold whatever it is, the goods or services, and the credit card has been charged, but that doesn't mean that the sale is final. You bear the risk. Second thing is, generally a lot of these processing services provide for a sum limit amount. And most important, I've highlighted in number 4, is there's a reserve account. And as I've experienced, the reserve account can be the most difficult because there is broad latitude for the credit card processor to reserve from what you think you're otherwise getting. And as I've touched on in this slide, the potential pitfalls of credit card transactions, there's imposition of fees, there's impositions of chargebacks because accounts are not purchased, they're conditional sales. There's holdbacks of additional amounts in the reserve account. There's holdback of funds for a potentially significant period of time. In this one, I believe there was at least 270 days or longer. And there's an imposition of liens on accounts. So if you have something that suggests that you're not allowed, or you have other documents that say you can't have other liens, you better make sure that that complies with your credit card. Okay, so I just told you all the pitfalls and shortfalls. And there are many. You can't avoid getting a loan. So what do you do? Well, I liken it to really, if you will, to going to the beach. You go to the ocean here in beautiful Southern California, and you go into the water and you expect that you're not going to get hit by waves. I think that's kind of unrealistic. I think really you're looking at 3 choices. You either don't go into the water, you go into the water and you stand there and get hit hard, or you manage the waves and you body surf and enjoy yourself. Clearly, businesses have to go into the water. So the question then is, how do you manage it? Well, what I'm suggesting here is the process of managing this. Number one, you got to know your company. As we've just discussed, your collateral base and your eligible inventory or eligible accounts is key. Know what you have to lend against or to borrow against. Number two, the reporting accounting function. As we've discussed, you have to know what you can do, what reports you can and can't provide, so that you know that you can meet the obligations that you're going to incur. The third part is you got to understand your working capital needs and the time frame for advances. And the fourth is you have to evaluate these needs against commitments. You've got to look at those covenants, affirmative and negative covenants, and see, can I do this? One of the most important areas that's not addressed is establishing internal coordination, a team approach. Too often, one party, either the CFO or the person in charge of financial or accounting issues, addresses these, and then they're given to an attorney. I would suggest that you have a team approach and coordinate this so that you evaluate your options, you know your company, and you move forward intelligently. Now, evaluating the lending options that fit your business is the key. So one of the areas to discuss, or one of the areas to know, is how to evaluate the price of the loan, the credit options, interest rates, and so forth. And again, that's a separate discussion. But as I've alluded to, it's much more than simply looking at the stated interest rate. The other thing is managing the risks and traps. Now, let's go back to the 4 questions that we started with. I just got a written notice that the company is in default. I do not understand what happened. My suggestion is, managing this process, create ongoing an overview or a cheat sheet of the loan and assign someone to confirm compliance. Stay ahead of the loan. Don't find out what's going on from the lender. Second question, our CFO tells me that despite the fact that sales are up, we're hit with a lot of upfront charges. Our business is fine. I'm told we're in trouble under the loan. What do you suggest? The answer in managing this is get your financial and legal teams together to understand what's going on with your business. Make business and financial decisions that drive your business back into compliance or prevent it from falling out of compliance in the first place. I had a very successful month. Sales were great, yet I'm thin on my loan and strapped for cash. The lender's not willing to extend credit for us to buy more money. What happened? Well, I think the key is set up a management to manage the process is recognize that, number one, your business needs a tighter budget. Recognize that you need to use the delta, the difference between the cost of your inventory and the sales price effectively, and should not go beyond that delta in paying non-inventory expenses. And number two, your business may need both a revolver and a term loan. The revolver is for your inventory, and the term is to cover those situations in which sales have gone well, yet your business has applied cash to non-inventory needs. And the fourth question, we have plenty of cash but have a problem with a large account. Just heard that the loan does not allow us to borrow. What do you suggest? Recognize the problems with factoring. You may want to find either a different factor, one that does it on approved accounts where they buy it as opposed to conditional sale, or seek to secure alternatives. This managing the risks, I think, also involves a couple other things. Very briefly, recognize for budgeting purposes the concepts of reserves, both on credit card sales and other loan facilities in general. Don't be surprised when the number that you think you get isn't there because of reserve. Recognize that your lender wants to make money, but also wants you to succeed, unless you have what we call a loan-to-own lender, which I hope you don't have. And accordingly, this invites the opportunity to develop a relationship over time based on performance. I value relationships and find that sometimes the best way to manage the loans is to manage the lending relationship. Recognize that you have to constantly be in the lending market testing what is out there and what are the alternatives if things go sideways. Revisit what other assets you may have to secure for purpose of advances. The growing areas I've suggested is intellectual property. Sometimes you can lend against a major contract, sometimes LCs. Always look around to see what you have and what may exist. And lastly, develop in managing the process, develop backup plans. One of the best things to do is to look at lending as one arrow in the quill of what I call cash source options. You've got others. You've got debt. You've got revenues and cash generated from operations. It's just one of many. So to kind of wrap it up, what's the goal of all of this? The goal is a successful strategy that maximizes leverage, minimizes costs, and helps drive cash flows. Know your company and its needs. Know the hard money options available to your company and what best fits your business. I hope that this program today will really help in that regard. Have an integrated team approach that involves financial, operational, legal, and management input. Understand the terms and conditions of your hard money loan and plan for risks, pitfalls, and problems. And lastly, continue to challenge your approach. Monitor performance. Hold your team accountable for results. Okay, well, time's up, and I want to thank you again for listening. And Shani for Burbe for doing an amazing job in helping me. Please feel free to send me any questions or call me if you have any questions or if I can be of any assistance. Thank you again for your participation. Take care.